Hello, everybody. My name is Ezri Schechter, and I'm an investment advisor at CM Capital, as well as a professor of finance and real estate at Baruch College's Zicklin School of Business in New York City. To quote the great Cy Sims, an educated consumer is our best customer. And to that point, we at CM Capital decided to open up CM Cap U, where we plan on introducing different investment topics and ideas for educational purposes to whoever is listening. Today, we'd like to introduce the concept of derivatives. Now, to some, derivatives are equivalent to a four-letter word on Wall Street and is the way many banks often get into trouble. However, when used differently, derivatives, specifically options, covered calls, are a great complement to an investment portfolio and can be used to hedge a position. Today's topic is called covered call writing. Now, most investors, when they buy a stock, are positioned to make money on the stock when the stock goes up. Some more sophisticated investors can even make money from a stock when it goes down, which is called shorting a stock. In both cases, the profit is derived off the direction of a stock in one direction. Either it goes up or it goes down. And as we all very well know and can appreciate, we don't have any control on the direction of a stock. In covered call writing, we put ourselves in a position that we make money if the stock goes up, we make money if the stock stays flat, and even in some capacity if it goes down. Sound crazy? Allow me to explain. Suppose one buys 1,000 shares of Apple at $187 a share. To most, if the stock goes up $2, they make $2,000. And to most, if the stock goes down $2, they lose $2,000. Covered calls, on the other hand, involves both buying 1,000 shares of Apple at 187 and then selling, for example, the August 190 calls for $10. In simple English, this trade involves buying the stock like you normally would, and then by selling those August 190 calls, you're offering out your stock for sale from now until August for $190, or a 3-point profit, $3,000, 187 to 190. And in return for offering out your stock for sale at 190, you receive $10 per share, or $10,000. That $10,000 is yours to keep, regardless of the direction of the stock, and is being given to you because you're offering your stock for sale at $190. Essentially, you're limiting your upside to $190, and you're being paid $10,000 to do so. So your potential gain is from 187 to 190 on the stock, $3,000, and the $10,000 on the covered call for a maximum potential gain of $13,000. That's the good news. The bad news, and there is bad news, is you are limiting your upside to 190 on the stock, plus the $10,000 on the option. So if Apple comes out with an iPhone 15, and if this phone actually has a battery that works and lasts long for a change, and the stock goes to $300, you limit your upside to $190. However, if the stock stays put around here, or goes up moderately, even goes down a bit, that $10,000 is yours to keep. And you do have the potential, as mentioned, to profit $3,000 additional on the stock. So basically, it's a lower risk, lower reward strategy that can be a great complement to your investments. And now for your PSA. As always, please make sure to discuss this with your investment advisor to confirm it's in line with your investment objectives. We hope you enjoyed our seminar. For the next class, we plan on discussing the effect of interest rates on fixed income, specifically bonds, and the concept of duration. See you soon.